Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone, and welcome to the Top 5 at 5. I'm Catherine Murray, and as always, I'm really thrilled to be able to bring to you some of the top minds in finance and investment ideas. Today, of course, we have Brian Madden, who's the Chief Investment Officer over at First Avenue Investment Counsel. Brian, welcome, and thanks so much for being with us.
Thanks, Catherine. Great to be here.
Great, and in your new role as Chief Investment Officer, so congrats on that.
Yeah, thank you. I've been drinking from a fire hose, as you do when you dive into a new role, having joined First Avenue as the CIO back. It's coming up on 3 months, but this is a high energy place. We're in the office 5 days a week, and it's a young, hungry, talented, energetic team that's growing organically and inorganically. We've just added 2 new people to my team. So we're here with our boots on, fighting for our investors every day, rolling up our sleeves and getting deep into these markets, looking for good ideas, macro and micro level. So I'm sure we'll talk about some of both today.
Yeah, absolutely. And it's been a very difficult start to the year, and certainly the markets have been very volatile lately. Why don't you just give us your top-down view?
Yeah, of course. That's obviously where we start as well in building portfolios and thinking about strategy and asset allocation, that sort of thing. We're positioning for what we characterize as a decelerating growth and decelerating inflation environment. I think the inflation deceleration is the more obvious of the two expectations, because when inflation is in like 65 font at the top above the fold on every newspaper and on the cover of every magazine, it's peak inflation mania. I'm sure if we looked at Google search trends, inflation is one of the buzziest of all buzzwords this past year. But the mathematics of the calculation is such that we think the comps are getting tougher, if you can say that, on inflation. And so we should see deceleration, which is not outright deflation, but just a slowing and a normalizing of the rate of inflation in the back half of the year. And similarly on growth, as we get into the middle of this year, the comparisons are pretty tough, because if you think back a year ago, we had the big reopening trade as the COVID lockdowns started easing up in the US. And then, with a bit more of a lag here in Canada. But then you had this sort of pouring gasoline on a fire stimulus, both fiscal and monetary, in Canada and the US last year. The fiscal stimulus has already become a headwind. So all those CERB checks and the whole alphabet soup of subsidies that were going out to households and businesses has basically been tapered off down to zero or close to zero, both sides of the border. And the monetary stimulus, both the quantitative easing has now become quantitative tightening. And we've started to see, the early stages of what looks like it could be a sharp and rapid rate hike cycle, with the bond market pricing something like 8 rate hikes on both sides of the border this year. So all that is going to temper growth, and, risk of recession is rising. We have to think of that as a non-trivial risk now.
But Brian, it's interesting that you see inflation peaking soon, it sounds like. And the reason why I say that it's interesting is because, one of the reasons why the market has been selling off, or, the rallies have faded, I think, is because, of course, people are concerned that the US Federal Reserve is going to continue to hike and hike too much, too far, too fast. If in fact inflation's peaking, they won't have to chase inflation, which should be somewhat supportive for equity market multiples, should it not?
Well, it should, if the Fed makes the right move and backs off on the rate hikes, recognizing peaking inflation. But the history of the Fed and particularly around turning points in the business cycle of doing the right thing is not particularly good. Engineering a soft landing is really difficult to do. And let's be clear, what the Fed wants to do is engineer a slowdown, because the inflation that we're seeing today is, some of it is supply side driven, like oil in particular, and some of these other commodity shortages and supply chain bottlenecks. But most of it is demand driven, like households and businesses are just really, really, really flush with cash, with, the COVID lockdowns having contributed to a lot of excess savings building up on household and corporate balance sheets. And so, it's driven a lot of demand, particularly for durables. So, think, Catherine, yourself, and I can think about myself. How many people do you know who bought a Harley Davidson, who put in a pool, who did a backyard reno, who bought a boat, who bought a snowmobile, who bought a new set of golf clubs? And that's all good. That stimulated the economy as it was intended to at the time when it was most needed a year ago. But the thing about durable goods that's different from services or consumable goods is you buy them once, right? The hot tub you put in on your back deck, you don't put another one in this year because you did it last year. And the Harley Davidson you bought, you don't replace it every year. And the boat you bought. And so all these one-time home renos and kind of lifestyle hardlines purchases, that's demand being pulled forward. And so with that demand pressure easing off, and with some of the supply chain gluts and commodity shortages easing, it's very difficult to make a case for inflation accelerating from here. And not the least of which reason is because it's a rate of change. And so it has that denominator effect. So when you're comping against very high inflation in the back half of last year, and then the early part of this year, it just gets hard to kind of keep accelerating from already high levels.
It's interesting as well, though, that, I was with a very well-known economist last week doing an event, and his focus was also on durable goods, that they are slowing, I think, to your point. At the same time, though, Brian, I think it's important to take a look at the shifts that are hopefully taking place as well, which means we're going back to how we used to see the economy, which was much more of a focus on services versus durable goods, and that hopefully the services side of the economic equation are picking up.
Well, yeah, and that's certainly the expectation we have. And so, some of the things we're looking for at what you could call the reopening trade are on the service side of the economy. Because I think, and we can't obviously generalize down to each and every single individual and household, but, we're thinking 2022 is probably going to be more, airfares and more concerts and more restaurant meals and less bread makers and less Pelotons and fewer Lululemon pants, right? I think people are really, really hungry to get back to, let's call it normal. And services are normal. The Canadian economy is 85% or more comprised of services. And you had a tourniquet placed around the neck of the service sector, big parts of it, for almost 2 years. And so people want it, they crave it, and they have all that stuff that is collecting dust in their basement now, or maybe it's being used every day. I don't know.
That's true. Speaking of services and Lululemon and some of the areas that maybe we won't focus on as much, but retail is certainly a focus, and that's your background as well in terms of specializing in retail over years, retail stocks that is. So, and one of them that you bring to us today is Dollarama. Why is that one of your top picks?
Yeah, I mean, certainly I've had an affinity for some of the retail names. And to be clear, Catherine, this has not been a sector that's been particularly easy to invest in over the last 10 years with the rise of e-commerce and, the fading relevance of malls and that sort of thing. But when you find a good defensible business model and a resilient retailer like Dollarama, you just want to own it. This has been a great company ever since the IPO in 2008 or 2009. It's up 10x or more. And it's because it's a good organic grower. And Canada has a dearth of organic growth stories. The store count has grown by leaps and bounds, over 1,400 stores now, and there's a runway to something north of 1,700 over the medium term, and they're opening 65 or 70 every year. They're good at growing same-store sales growth, kind of mid-single digit pace, obviously a lot more during the pandemic because it was deemed an essential retailer. but nevertheless, they're comping against those tough comps pretty well here. And then it's just very cash generative because it's a capital light expansion model. It's only a few $100,000 to do the leasehold improvements in each store, payback periods less than 2 years. So they just generate a ton of cash. So they pay a dividend, they grow it steadily. It's not a high yielding name, but they also buy back 3 or 4% of their shares every year. And it all rolls up nicely to a double-digit earnings growth algorithm that is sustainable over the medium term, if not longer. And with a nice kicker, actually, of a Latin American geographic expansion that's been going on for the better part of a decade and is probably not well known or understood out there.
So a couple of questions. When we do see the stock get hit, what's the cause of that?
Beta, I think, is part of it. It's not a particularly high beta stock, but it is a stock. And so when the market is down, sometimes a rising tide lifts all boats, sometimes a falling tide will lower all boats. And so it's that, in particular, if it's been weak on certain days this year, let's recognize that it is a growth stock. It's not like a super high valuation, high expectation growth stock, but it does trade at a premium to the market. And so when you have a rising interest rate environment, you can think of growth stocks as being long duration. So just like long duration bonds are not something you'd want to be long this year at all, because they are very interest rate sensitive. High multiple growth stocks have more interest rate sensitivity, because more of the value of the name is concentrated in those far out years because of the growth and the compounding. So when rates rise, high multiple stocks are a bit more vulnerable than the overall general market to that valuation effect.
What's the overall market, or what's the multiple on Dollarama today around?
It would be in the low 20s, like 23. I don't have the number off the top of my head, but I'll give you a confidence interval. I'll say with high confidence, it's between about 22 and 26.
Okay. It's not a cheap stock, but you would feel comfortable putting new money to work in the name today.
Oh, for sure. In fact, it's a name that we added recently to our own growth portfolio back, I want to say, a month and a half or so ago.
Okay. The other interesting aspect to consider when you have dollar stores, whether it's in the States or Canada, is, when you have uncertain times or inflation or what have you, you do see a trade down effect. People who may not have gone to the dollar stores before actually start to go to the dollar stores. There's almost a bit of an economic impact that translates into the dollar stores, and also, of course, when oil's high.
I'm really glad you pointed that out, Catherine, because that actually played into our thinking and adding the name to the portfolio as well. Like if you think about, again, tying it back to the macro stuff we talked about off the top of the show here, yes, inflation is very high. And the pertinent fact here is that it's higher than average real wage growth, which means people's purchasing power is shrinking, right? And, as well as I do, many Canadians are paycheck to paycheck households and are, of course, value conscious. And Dollarama brings more bang for your buck in terms of value per dollar than really any other retailer selling comparable products. So yeah, people whose pockets are feeling pinched by inflation, rising interest rates, mortgages resetting, filling up the gas tank, maybe they used to buy certain consumables in Metro or Loblaws or Sobeys, and maybe those purchases are now shifting to Dollarama, where the price the value per dollar is greater. Yeah,
it's definitely worth a look. It's amazing how much you can find in there.
It is, yeah. It's not a glam shopping experience, but for the value conscious shopper, it's you'd be surprised what you find there, and you'll find more there going forward because they're rolling out another higher price point. Actually, they just announced that last quarter, so up to $5.
Okay, interesting. Yeah, I know. I love it. So many years ago, when the dollar stores, everything then's $2, $3, now $5. I guess.
Right. Yeah.
That's okay. That's okay. Let's take a look at another stock, Nutrien. Why? I mean, obviously, we're seeing not only the inflation effects of oil, but also, of course, fertilizers and food prices. So, but how much of that is already reflected in the stock?
Yeah, so this is a stock we added to our Momentum portfolio, along with another fertilizer name back a few months ago. So the nature of this Momentum portfolio is colloquially, sometimes say like we might be here for a good time, not a long time. So it's more trading oriented. We still own the name, we still like it, still adding to positions, but Nutrien is just experiencing a bonanza of cash flow this year, and that's bolstered, of course, by very high fertilizer prices, which themselves were, even prior to going into 2022, bolstered by very high cash crop prices, so corn, wheat, soybeans, and the like, and accordingly very strong farmer economics, incentivizing fertilizer applications, that sort of thing. And then we had the war in Russia and Ukraine. Ukraine, of course, is often referred to as the world's breadbasket. There's just tons of wheat and grain exports that go out of there. But the other thing is Russia produces a lot of that too. So those markets for cash crop commodities have gotten tight, really tight, like cycle high, all-time high pricing. And then fertilizer markets, Russia and Belarus are massive. They're almost like a Saudi Arabia of fertilizers, so phosphate and potash. And so Belarus had already been under economic sanctions for, kind of being naughty on the world stage a few years back. Russia obviously, took that title from them, dramatically this year with the invasion of Ukraine. So fertilizer prices are just over the moon. And Nutrien has 6 world-class potash mines that are still producing here in Canada. They produce nitrogen, they produce phosphates, and the prices for all 3 of those commodities are just creating a gusher of cash flow for them. So we think they're going to deploy that cash wisely into organic growth, into buying back their shares, which they've already been doing prolifically, and making acquisitions, likely overseas in places like Australia and Brazil, where they've got nice footprints but want to grow.
Would there be an expectation of a special dividend?
Could well happen, yeah. Could well happen, because it's almost going to be an embarrassment of riches how much cash flow they generate this year, and they're already, they already have a pretty clean balance sheet that's been delevered nicely after the merger of Agrium and the predecessor company Potash. So this is going to be just an absolute windfall year of earnings for them, like probably 4x what they earned in 2019, for instance.
And in terms of this stock is in your momentum portfolio, so you obviously bought it lower than where it is, and then kind of riding the momentum of what's going on within that area of the world. I guess, where does it trade, and how long can you hold on to it for?
Well, momentum, I guess there's a lot goes into it. There's a quantitative model, there's some fundamental thinking, there's some technical analysis, and then there's a macro strategic wrapper around all of it. But, to kind of boil it down to something simple and approachable, momentum, the gist of it is the trend is your friend. So what we're talking about here is trend in price, trend in reported earnings, trend in expected earnings, and pattern of reported earnings versus consensus expectations. So we will own it, up until such time as it doesn't keep having that trend at its back. And so right now it still does. I wouldn't want to hazard a guess as to just how long we'll have it, but I would say, it's probably only an even probability of us having it on the books come, New Year's Day 2023.
Okay.
Because it is getting late in the fertilizer cycle, Catherine. And so, when you run a momentum strategy, you do need to be nimble, because I'll remind you, and you'll remember this, the predecessor company, Potash Corp of Saskatchewan, went on a moonshot back in 2007. The last time fertilizer prices were this tight, it briefly became the biggest company by market capitalization on the TSX. And then it did a face plant and fell 80% in the down cycle very, very quickly. So, you don't want to overstay your welcome on a momentum trade is sort of the point I'm trying to make here.
Yeah, that's a great point. People have to, recognize the characteristics of certain stocks because of the sectors that they're in, i.e. commodities. And you have to really just, be aware of exactly what it is, and, the stocks that you marry versus the stocks that you date.
Bingo. Yeah, I didn't want to use that terminology. Better you should do it.
Fair point. All right, in the interest of time, because we're doing these top 5 in 20 minutes, Agnico Eagle. I've thought of actually buying a gold stock as well for, I don't know if it's hedging or what I'm thinking, but why are you owning it?
Well, I guess the number one best reason is we're bullish on gold. So gold is gold is an enigma. Let's just acknowledge that gold does what it does. And, I think you just have to respect what the market is telling you by observing the price action in gold. But in terms of sort of theoretical backing for the bull case on gold, gold has classically been an inflation hedge. We have, the highest inflation you or I have seen in our lifetimes, or at least would remember in our lifetimes. And gold is also classically thought of as a geopolitical risk hedge. And with the war in Europe, the most severe since the Second World War, I think it's fair to say that we have a lot of geopolitical risk on the table. So gold is in gear and is testing resistance near the all-time highs around that 2000 mark. Agnico is a high quality, I would almost dare to say, one of the best of breed producers in the space. It's light on geopolitical risks with 12 producing mines in Canada, Finland, Mexico, and Australia. And these are places that have good rule of law and where you're not at risk of, the government of the day arbitrarily nationalizing your gold mine, as so often happens. Or, as some Canadian producers have found, mining gold in Russia is all good until all of a sudden it's not, right?
Yeah.
So yeah, these guys are lean operators. They're very judicious in making acquisitions with their own shares. The share count doesn't dilute serially year in and year out like a lot of gold mining companies do. And they like, high grade, good assets that are easy to operate, simple metallurgy and safe, stable jurisdictions. They just completed the merger with Kirkland Lake Mines. That makes them bigger, more market cap. It makes them more relevant to more investors. So, a good operator and a good advantaged commodity right now.
Okay. And taking a look at another name, Live Nation.
Right. So this is kind of back to what we talked about, on the open, more services and less things. This is the year where we go back to doing things instead of buying things. And Live Nation is the parent company of Ticketmaster. And so they control about 235 event venues, a lot of them in the US, but some elsewhere in Europe, here in Canada. They've got a really big programming calendar for this summer. A typical summer will have about 25 large-scale concert tours going on. They've got something closer to 45. And so volume demand is up strongly, 20% plus, year over year. Average ticket pricing is up double digits as well. Then there's ancillary revenue streams as well as sponsorships and all the merchandise that's sold on site. So they get, a piece of the action there. And then during the pandemic, obviously, it was kind of an existential crisis for them, right? With a lot of these things shut down. So they effected a $200 million internal cost saving initiative, some of which is structural, meaning it wasn't just an emergency, turn off the discretionary spend, but it was thoughtful, longer-term strategic cost takeouts. And so that will continue to accrue to their benefit. So good sort of cyclical demand backdrop, we think, and thematically advantaged in a reopening economy. And kind of a unique exposure too. There's not a lot of, it's hard to think of a similar company out there. So good reopening trade play.
Yeah, interesting reopening trade, of course. We always tend to think of the cruise lines and the airlines. This is another kind of add-on. And I think everybody wants to get out there and get to some concerts for sure. All of us.
Amen to that.
Let's take a look at the last one, CVS.
Very recent addition. We bought this just over a week ago. So, viewers in the US, of course, will recognize this. It's the ubiquitous pharmacy chain, and Canadians that have been traveling in the US will, of course, recognize it as well. They like to state that 85% of the American population lives within 10 miles. Yeah, it would be miles, not kilometers, of one of their retail stores. So that's all true. There's about 9,900 stores, which is just a massive footprint. You think about how ubiquitous Shoppers is here, and they only have 13 or 1,400 stores. So CVS is everywhere. You just can't, you stumble upon them accidentally when you're down in the States. But it's more than that. So that was kind of the old CVS pre-2006, 2007. In 2006, 2007, They bought a pharmacy benefits manager called Caremark. So that became a very big business, almost to rival the pharmacy business. And then about 4 years ago, they acquired Aetna, the health insurer and managed care organization, which is actually now their largest line of business. So what used to be thought of quite correctly as a dominant player in a fairly oligopolistic pharmacy business is now a completely vertically integrated healthcare behemoth. So you've got the upstream managed care organization, the health insurance. You've got the midstream pharmacy benefits manager, which is sort of an intermediary between insurers and managed care organizations and drug companies, and then does fulfillment and stuff down into the pharmacies. And then you've got the retail footprint. So they're doing really interesting things. And I think, obviously healthcare is secularly advantaged by the aging demographics. And let's face it, Catherine, quite a lot of morbidity and disease in the United States. So it grows faster than overall GDP. And the recent acquisitions that they've done give them good strategic optionality that helps them, I think, overall deliver lower cost healthcare and better outcomes to a lot of Americans.
Yeah. What's the valuation on it? It's interesting that you just added to it. Is it attractive right now?
Well, yeah, it really is. It's an undemanding valuation. It's about 13 times earnings. So, wow. That's a discount to the overall market. It grows more quickly. It's sort of a high single-digit earnings grower with a couple % of dividend yield. So you put those two together, you got a good line of sight to a double-digit return over a cycle. And you really to even speak of a cycle when you speak of this company is kind of off base, because it's not cyclical. That's the thing, right? Whatever happens to the economy, people need their prescriptions and they need their health insurance and they need their hospital stays. And so it's a very, 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 very steady, stable, non-cyclical growth company trading at an undemanding multiple.
Nice. All right, Brian, we're going to leave it there. Thank you. In terms of your firm, if people are interested, they can obviously call you or touch base with your colleagues, salespeople.
Absolutely. We love talking to people.
And what I was going to ask though, what's the approach of the firm in the sense that are they pooled accounts or segregated accounts?
Yeah, we primarily manage pooled funds. So equities, we've got 3 different style diverse approaches to managing equities. We also manage fixed income, and Catherine, fairly unique and differentiated among boutique investment counsel firms. We have an integrated in-house alternatives capability because we have a sister company affiliate that does real estate development called Emblem Developments. So we can offer affluent and high net worth client families, proprietary access to real estate, which is something that a lot of small to mid-sized investment counsel firms can't do. And we also have an integrated, very sophisticated family office capability, deep expertise in financial planning, estates, trusts, tax planning, and all that sort of stuff. So it's a pretty broad and deep lineup of products and services that we offer. So yeah.
Okay, great. Brian, thank you so much for your time today.
Real pleasure, Catherine. Thanks for the invite, and have a great day.